Oil refining, telecom networks, retail stores, solar gigafactories, artificial intelligence infrastructure. It sounds like five different companies, but it is one balance sheet. Hello everyone, I am CSAB George and this is Decoding Equity, where companies are analyzed through numbers and not by noise. Today, we decode Reliance Industries. Structurally, Reliance operates through four segments: oil to chemicals, oil and gas, digital services, and retail. Oil to chemicals remains the cash backbone. Oil and gas adds upstream energy exposure. Digital services under geo platforms drive telecom-led growth. Retail continues to scale and improve the profitability. Together, these business blend stable energy cash flows with scalable consumer and digital platforms. Scale alone does not guarantee shareholder returns. Capital allocation and return efficiency ultimately determine the value. Let us examine the numbers. Over the last 3 years, quarterly revenue moved from 2.17 lakh crores in December 2022 to 2.65 crores in December 2025. After stable financial year 2024, around 2.3 lakhs crores, financial year 25 show renewed acceleration, with March 2025 touching 2.61 crore. This reflects the improving top line momentum. Growth must translate into profitability. Operating margins have remained steady between 16 to 18% despite the crude volatility, indicating the diversified earnings support across segments. Net profit rose from 17,806 crore in December 22 to 22,290 crore in December 2025. Excluding the June 25 spike driven by other income, profits are compounding in the 21,000 to 23,000 crore range, suggesting the stable underlying growth. Profit quality is equally important. Over 5 years, net profit increased from 53,700 crore in FY21 to over 81,000 crores in financial year 25, while operating cash flow surged from 26,958 crore to nearly 1.79 lakh crores. In recent years, cash from operation has remained consistently above net profit, reinforcing the earning strength backed by real cash generation. There is a market discussion around a possible future retail demerger. If executed, it could allow the independent valuation discovery for the retail vertical, similar to the geo financial separation. However, this remains speculative and value creation would depend on execution. If this style of analytical breakdown adds value to you, consider subscribing. I publish structured company research regularly for the serious investors. Expansion requires balance sheet discipline. Debt equity has stayed between 0.38 and 0.45 despite large investments. Interest coverage improved from 3.8 times in FY21 to above 7 times and remains comfortable, indicating the controlled financial risk. With the leverage stable, capital efficiency becomes a focus. ROCE improved from around 8% in FY21 to 13% in FY25, reflecting better utilization. ROE remains in the 8 to 10% range due to the large equity base. Sustained improvement in the capital efficiency will be the key going forward. From a valuation perspective, the stock has traded between 23 and 29 times earnings over the last year with a median near 25.7. It is currently hovering near the midpoint, suggesting the valuation is within the normal historical band. Further re-rating would require earnings acceleration and stronger return ratios. Let us look at the institutional holding data. Over 3 years, FII holding declined from about 22.5% to 19%, while the DII holding increased from nearly 16% to above 20%. Promoter holding remained stable near 50%, reflecting the ownership continuity. Risks include refining margin volatility, capital intensity in the new energy, telecom regulatory exposure, and execution challenges. Capital allocation discipline remains central. Reliance today is not merely an energy company, it is a diversified holding structure. The long term story depends less on scale, more on capital efficiency and execution quality. This content is for educational purpose only and not an investment recommendation. Please do your own research or consult your financial advisor before making investment decisions. This is CSAP Charge and this has been Decoding Equity. Thank you for watching. I will see you in the next structured analysis.